Hello everyone, welcome back to the channel Ajay Sharma. So today we are going to discuss about the principles of insurance. It is a very important topic, and in this video I will explain all type of insurance, only the principles of insurance. So if you are new on this channel, so hit the bell icon and subscribe button. So let's go. Principle of insurance. So first of all, what is insurance? Now, insurance is basically an agreement where one side, the insurer, promises to cover the loss of the other side, the insured, if a certain event happens. But for insurance to really work the fairly, there are simple and some golden rules that the both party must be followed. These are called the principle of insurance. Let's break them down one by one with the examples. Number first, principle of utmost good faith. This simply means the both parties need to be completed honest, and the insured must tell the company everything important about the subject of insurance, and the insurer must also share the terms clearly. It means to be, it depend upon the honesty, and the insurer disclose all the fact relating to that, the insurance and the policies and the premium, what type of insurance they would be give and claimant. So for example, if someone has a heart problem but hides it while taking the life insurance, the company can refuse the claim letter. So honesty is the key here. It's just an example of the principle of utmost good faith, to be clearly and honestly. So let's we talk about the next principle. Principle of insurable interest. This rule says you can only insure something if you will face a financial losses if it's damaged. If you do not have any monetary connection, you cannot insure it. For example, you can insure your own car or own house, but you cannot insure your neighbor's house because you won't have lose money if something happens to it. It means the things are belongs to you, and you have personally and interest in that about these things related to the insurance. The main key point is, the first of all, in the first principle we learn about the keyword honesty, and the second interest is in insurable interest we also know your own personal interest. Regarding to that, you can claim your insurance. So let's we talk about the third principle, principle of indemnity. The principle of indemnity means that the insured shall be the compensated only to the exact of the actual losses suffered with subject to the sum assured. The objective is to place the insured as far as possible in the same financial position after the loss as he was in immediately before it. It prevents the insured from making a profit out of insurance. Insurance claimant, it does not part of a profit. Insurance is not for profit making, first of all, and it is only to bring you back to the some positions as before the losses. The company pay you only the actual losses, not for your profit generation. Is not a main criteria or a main point here. So for example, if you have a car and that car was insured 5 lakh and the damage is just for 2 lakh, the insurer will pay only the 2 lakh, not to the whole amount. The question is that, what in the case of a life insurance, in the principle of indemnity will happens on that situation? Comment the answer below. in the video. Okay, so let's we discuss about the another principle of contribution. When the same subject matter is insured with the more than one insurer, in the event of a loss, the insured cannot recover more than the actual loss suffered. The insurer are also bound to the share the loss proportionality. This principle ensure the fairness and prevent unjust enrichment of the insurance. Oh, basically the principle of contribution deals with the if you are insured the same thing with more than one company, you still cannot get more than your actual losses. It's mean, and the companies will share the payment in the proportion. For example, a house of a worth 10 lakh is insured with the two companies or either three companies, one for 6 lakh and another for 4 lakh. And if the losses is 5 lakh, the first company pays you 3 lakhs and the second pays 2 lakh. First company A and company B are contribute to payment of the insurance to the claimant. 3 plus 2 is equal to equal loss, actual losses of that person equal to 5 lakhs. That type of contribution by A and B are known as principle of contribution here. Next, principle of subrogation. This principle provides that after the insurer has indemnified the insurer acquired the legal right to step into the shoes of the another insured and recover the losses from the third party responsible for the damage. This prevents the insured from recovering compensation twice for a same loss. It means once the insurer pay you for the losses, they step into your shoes and can recover the money from the third party responsible for the damage. For example, if you are insured your car and get hit by someone else negligently, and you insure, it means your insurance pay you for it, and the company can then take actions against that person to recover the money, and the company step in the shoes of in the place of at the place of yourself. So principle of subrogation, we also read about the Indian Contract Act 1872, step in the shoes of another in the contract of guarantee. Section I think 126 of Indian Contract Act deals with the guarantee. The three party contract. Meaning of subrogation is that the step you are choosing the another person. Next principle of proximate cause. According to this principle, when losses occur due to the multiple causes and the nearest or the most dominant cause of the loss should be considered to determine whether the insurer is liable. If the proximate cause is covered under the policy, the insurer is liable to, otherwise the claim is not payable. It means that when losses happen due to the multiple reasons, the most direct or nearest cause is considered. If that the cause is covered in the causes are that covered in the policy, the company has to pay and company is liable to be paid. And if your premium and the policy what you get and does not cover about the whatever the terms and condition of that contract or your insurance policy, so that company is liable, otherwise company is not liable if your according to the terms and condition of that company are not mentioned in your insurance bill. So for example, if your goods catch the fires because of lightning and fire is insured in the policy, then the insurer will be paid since fire was the immediate cause of the loss. Here is the principle of proximate cause of principle of insurance. Next principle of loss minimization. This principle lays down that it is the duty of the insured to take all the reasonable steps to minimize the loss to the subject matter of the insurance in the claim event of mishappening, and insurance is not a license for negligence, and the insured must act as if the property will uninsured. This principle says that the insured must also take a reasonable care to reduce the losses. Just because you have the insurance doesn't mean you can act carelessly. For example, if the fire breakouts in your house, you must call the fire brigade and try to save as much as possible instead of doing nothing. That deals about the principle of loss minimization. So friends, these are the 7 principles of insurance. They make sure the insurance works smoothly, fairly and without the misuse. If you found this helpful, so don't forget to hit the like button, share it with your friends and subscribe for more educational content. See you in the next video. Okay, bye bye guys.